How safe is my FDIC insured account? How safe is my bank? What would be the longest period of time before the FDIC would pay me back if they ran out of money? What is FDIC? Hi, my name is Lindsay McLaughlin, and since 2008, these are the burning questions that people all of a sudden had to know the answers to. My husband would be asked these questions. He had worked in the banking industry and at the time was an advisor for people interested in banking products such as CDs and money market accounts, as well as other insured investments. And unfortunately, he had to admit that his explanations were woefully inadequate. No one had really questioned him in the past, and Paul, my husband, had to admit, as many others did, that he really didn't think it was an issue at the time. After all, this was an account guaranteed by our government, and that was good enough for him, and many others. But, as we all know, after 2008, things changed. Banks were closing right and left. Even big banks, such as IndyMac, the second largest bank failure in U.S. history, went belly up. No one seemed to see it coming as the bank's financial rating was fine. We all, even the experts, were blindsided. And after that, Paul's clients weren't just asking about interest rates, but they also wanted to know how safe the banks were that he recommended, which was very understandable in the present financial environment. There was no choice. Paul took pride in saying all the time that since 1999, when he chose the investment field, he never had to explain to a client that he was sorry for losing your money, because he never had to. He had never lost a dime. Paul certainly didn't want to have to start now. So he started asking questions. The first place he decided to go is to the source itself. He contacted FDIC themselves, and by email he asked the burning questions Paul's clients wanted to know. The first question was something that was asked more often than any, and seemed to be the most misunderstood by even the most experienced bank employee he questioned. How long would it take to get my money back if my bank went bankrupt? Paul had gotten many different answers, immediately, 5 years, 10 years, 99 years, and so on. No one seemed to have a definitive answer. FDIC's response to Paul's question was, since 1933, no one has ever lost a penny in FDIC-insured accounts. Okay. So Paul responded with, well, since 1933, we have never been in such bad shape in the banking industry with nothing but dark clouds on the horizon. So taking that into account, let's just say FDIC ran out of money and everything that could go wrong did. How long would it take for a person to see a return of his FDIC insured account? The response was the same. Since 1933, no one has ever lost a penny in FDIC insured accounts. Now Paul was angry, as well as suspicious. What was the answer they didn't want to divulge? That started Paul on a quest to find the answers no one wanted to give out to the public. What did the FDIC have to hide? At the time, there was nowhere other than the FDIC to find out and answer the question. Paul got in his computer every chance he could between client appointments and scoured the internet for answers. It took almost a year. Finally, the answers were found. Apparently, after 2008, there were many people asking the same questions. And what Paul found out was if you Google the right questions, eventually you will find the right answers. At that point, Paul asked me to help him in his detective work, and the answers started to come. The further we dug, the more shocked we were. The information we found was worse than we even imagined. But before we go any further, let's take a look where we are and how we got here. On July 11, 2008, the headlines read, "The first bank just went under. IndyMac, with total assets of $32.01 billion and total deposits of $19.06 billion, was the fifth bank to have failed that year. Between 2005 and 2007, there had been only 3 bank failures. There were 702 banks on the FDIC's problem bank list at the end of 2009. And 252 at the end of 2008. The FDIC officials said they expected the number of failed banks to peak this year after climbing steadily over the past 3 years. At the end of the year, that number had climbed to 775 despite the reports that there were signs of optimism in the banking industry. Despite the call for government to break up the too-big-to-fail banks, they just got bigger and bigger. Monday, November 22, 2010, at 7:30 a.m., the government released new data showing that the FDIC's list of problem banks now includes 903 institutions. That's 10 times the number of bad banks on the FDIC's list just 2 years ago. The banks on the list have $419.6 billion in assets, or 16 times the amount of 2 years ago. And yet, these bad banks are just the tip of the iceberg. At the time this information was available, the coverage was for 100,000, not 250,000. My point in displaying these numbers is to show just how little money there was covering your investments in FDIC insured accounts. Less than 2 cents for every dollar. Were you aware of this? The 1.22 reserve ratio means that for every dollar in your bank account, the FDIC has 1.22 cents in reserve, ready to cover your potential losses. This has proved to be an ample amount during the period of stability we've recently had. But it doesn't seem particularly significant considering the recent headlines about banking losses. Consider, for a moment, the collapse of Bear Stearns. In order to assume that bank JP Morgan asked for and received a special waiver from the Federal Reserve to keep $400 billion of suspect of Bear Stearns assets off the books of JP Morgan, while JPM may have been padding the books a little bit here, due to the uncertainty of how bad the wreckage might turn out to be, $400 billion dwarfs the $52 billion reserves of the FDIC. If one medium-large bank collapse could wipe out the FDIC by a factor of nearly 8, what do you suppose would happen if there were multiple, simultaneous bank failures? At this point, my guess would be that Congress would be sorely tempted to borrow additional funds to remedy the situation. But I worry that hardship and losses might result while the laws were amended and sufficient funding avenues identified. So how many bank failures could the FDIC endure? The data suggests slightly fewer than one big one. This was all the reserve that was backing up your funds in 2008. Of course, amounts have changed, as there is now $250,000 that is insured in the bank accounts, such as CDs and money market accounts, and there is no limit to the amounts covered on checking accounts. As of this time, in 2012, all indications are that the situation has not improved, but it is really irrelevant when you look at the trillions that FDIC is responsible for, as we will see. But ask yourself, if you are aware of this fact, what else is there you're not aware of? Do these figures promote a feeling of security for you? As of March 2012, there are estimated to be between 1,343 banks on the watch list, according to Bankrate.com. When will it end? So what have been the effects on the FDIC during this time period since 2008? What has been their response to the crisis? And what did they tell us? The date of August 2009 was very significant to anyone with money in FDIC-insured accounts, because this is when FDIC ran out of money. In 2008, there was $53 billion in FDIC, and in 18 months, it had dwindled down to zero, according to Jake Town. I would say a bit of news worth reporting, wouldn't you? As you can see, FDIC Chairwoman Sheila Bair was still singing the same tune, that FDIC has never failed to protect insured accounts. Ms. Bair has since resigned from her position. So what was the FDIC's strategy now that it was broke and banks were still failing? Well, on October 2009, FDIC required banks to prepay 3 years of premiums, adding up to nearly $45 billion that many banks on the edge could barely afford, and some couldn't, which further added to the toll of failed banks. Why didn't we hear of it? Robbing from Peter to pay Paul. What was the sense of it? And all the while, big banks were just absorbing more banks, just making them bigger and bigger. Each failed bank's toxic assets being absorbed as well. In the end, as we saw recently, when major banks were raided, we saw many of the biggest top banks didn't look so sound financially, even with their talent for creative bookkeeping. Well, the good news came November of 2009 that the FDIC had a credit limit of $500 billion from the U.S. Treasury. But as we see, it barely will cover what is estimated in losses, and later you will see it is not even close to what FDIC is responsible for, which is in the trillions of toxic investments made by banks. This brings me to the question, what is FDIC? Is it an account? Is it enough to get through all of this? Does it actually exist? Where did all of those premiums go, and how many cents for every dollar was backing my money? How the heck does it work? This article gives us a better understanding of just what we are depending on, and it does not give reason to feel secure. And if you think 2008 was a bad year, wait until you see 2012. The world's largest banks have far less capital. The world's largest government have far less bailout power, and each is pulling the other into an abyss. Yet both bankers and government officials seem mostly oblivious to the dire realities, sleepwalking through daily life as if nothing has changed. Banking reform has not taken a hold. Wall Street is still in business as usual despite lessons that should have been learned from the past. And again, believe it or not, this is only the tip of the iceberg. The future only looks worse from even other standpoints. If our banking system were to survive from mismanagement, underfunding, fraud, embezzlement, and a myriad of other obstacles that $500 billion could get us through, there is still first, the troubles in Europe. Second, lawsuits and/or indictments against banks. Federal regulators filed lawsuits against 17 financial institutions for allegedly misrepresenting the poor quality of mortgage securities they sold to Fannie Mae and Freddie Mac at the height of the housing bubble. Now this one is important because we're talking about over $55 trillion of toxic assets in just one bank alone. Bank of America under FDIC's jurisdiction. I'll say that again, $55 trillion. That $500 billion credit FDIC has with the federal government doesn't sound like a whole lot of security, now does it? And another question you may want to ask yourself if you're thinking bailout is what politician would even suggest a bailout for these banks? They would be insane. Their careers would be over, if not worse. We don't have people in Washington who would be so bold. Here is a video from journalist Matt Taibbi on just what I'm talking about. A very informative bit of information of just what is the banking industry and its practices that put your money in danger. On March 14, 2012, Mr. Taibbi reported on bank stress test and how banks like Ally, SunTrust, Citigroup, and MetLife failed to pass these tests. These are big banks, folks.
Last year, Bank of America shifted trillions of dollars worth of derivatives, very risky, toxic derivatives, from Merrill's books to its own depository side, essentially putting all of us on the hook for some of its most dangerous bets. And then again, we have the thing like the stress test, which is essentially an official government endorsement of the widespread accounting fraud that you talk about with all of these companies, and they're all guilty of it equally.
Soon you may be hearing of how Wall Street banks are being sued by their own employees to the tune of $2 billion for damage to their 401k plans. Just another nail in the coffin of banks. The emerging LIBOR scandal out of London. This is another big hit to the American banking industry. Actually, the global banking industry. Quite shocking. So the questions that plague us today are, how safe is my money? How safe is my bank? How long does the FDIC have to pay me back if worst-case scenarios are realized? What alternatives are there where I can invest my money where it is safe, guaranteed, and insured? And where can I find this information now so I don't have to spend a year or two as Paul and I did to find these answers? We have those answers for you so that you can sleep at night. In 1929, many were caught unaware and lost everything because they thought they were safe. Now as then, there were warning signs. And there are many warning signs now, too many to mention here. Let us show you what they are. There is so much more you should know, but are not being told in the media. And that's understandable. If you knew, you would pull your money out of your bank along with everyone else. And be honest with yourself. For the return you're receiving from your bank investments, is it really worth the risk? If this is what you're thinking at this moment, apparently you're not alone. What do these people know that you don't? Let us help you find out.